Hello, everybody. So, on a day like this, I'm interrupting my usual program of videos to talk about the crash because it did crash hard. To me, this is the worst one we've had this year so far. How many of these are we going to get in a year? Is it 2 or 3 a year? Do you get something like that? At least for growth stocks, right? The overall market was, I guess bad, but okay-ish bad. But really, our stocks, the stocks I cover on this channel, it was a bloodbath today, and I don't expect we're gonna get a lot of days like this. Perhaps a handful of days like this a year. So this is the shopping list. This is the stocks that I like right now. This is the stocks that I find cheap. So the first stock that got absolutely slaughtered today was Microstrategy. It's trading at 250. I never thought we would see that level again. I'm sure many people in the MSTR community did not think that would happen again. You can see Bitcoin was not even down 4%, 3.98, but MicroStrategy was down 11%. At some point during the day, more than 13%. It was down by this much. MicroStrategy is now trading at a 1.46x price to NAV. It is one of the cheapest that I have seen in the past 3 to 4 months. Note that CELH likely has some dry powder left. I am now happy that he did not spend the 2.3 billion right away. He only spent 1.99 billion last week, and so this week is he buying again? Most likely, and if he is, we are sorry, we're going to see a likely low buy. It'd be really good to see him buy a few $100 million of Bitcoin at under 90K by Monday, and I am confident that he's buying some and creating some of that yield for the shareholders. Another stock that got even cheaper is Mara Holdings, down almost 11% today. This is yet one of these stocks that I didn't think would go so low. Now 94% of the market cap of Mara Holdings can consist of Bitcoin, can be seen as Bitcoin. So this is roughly like buying an ETF, or almost, right? You're only paying a 7% premium over the Bitcoin. Never mind, they have thriving mining operations. Their strategy, like I said multiple times, is a little older miners. They want to keep their miners for the longest time, and what they do is they dispatch their miners, they move their miners based on the lower cost of energy, the lowest cost of energy, and they try to get access to that energy when it costs something like 1 cent a kilowatt hour. That's the strategy. The other strategy that Mara has, that the market has ignored, is the issuance of convertible debt to buy Bitcoin. So that's following the debt playbook of MicroStrategy. Now, obviously, Mara is not a stock that can really do ATM at 1.07, and I don't think MicroStrategy is doing ATM either at a 1.46. CELH is now looking really smart, having done ATM at a 1.9, a 1.8, and a 2x price to NAV. The leaders of these firms have the pulse on the market, and I am pleased to see what they have been doing, even though right now, of course, it feels awful. The portfolio's down, the stocks are down. You're all looking at your portfolios and you're like, well, I was much richer a week ago. Well, yeah, but volatility is the price you pay for higher returns over the long run. Stocks that don't move that much do not return nearly as much over, say, a 5-year, a 10-year period. At least that is my no financial advice point of view. Moving on to other stocks that I cover in the channel, I'm big on healthcare. Today, these consumer-facing healthcare companies that I follow were way down. Both of those are LifeMD and HIMS. I consider these stocks to be very cheap on my spreadsheet. At a 0.11 for HIMS, HIMS is decidedly back to its historical, quote-unquote, historical cheapness, and that's thanks to a 22% drawdown. And this is very annoying because, of course, HIMS's growth has kept on the acceleration. The acceleration that we saw in November for HIMS has kept going up until now. We did not fall back to the old trajectory of growth of growing 50% a year. We are now growing well into the 60% a year, and that's thanks to the weight loss category. Yes, there are fears as to how much of a weight loss business is going to be gone, but if you listened to the conference call of HIMS, which I did, which was supposed to be the topic of today's video, you know that the CEO of HIMS is very bullish on liraglutide paired with medication, paired with the pills. A liraglutide, for example, paired with a metformin bupropion type pill, and you can get weight loss that are much closer to actually the semaglutide weight loss. And semaglutide weight loss is about 15%. Liraglutide weight loss is about 5%. Based on what I understand, the CEO thinks you can come up with an offering without the semaglutide, an offering with a lot of customers that have been satisfied with HIMS are likely to switch to. Not all of them will switch, but many of them will switch to the liraglutide offering, which is the generic GLP-1 that HIMS is going to manufacture. So there is no guarantee that HIMS will lose that much business. And even if they did, they're going to move back from 60% growth back to 45, 50% growth. Like, big deal. That's not that big of a drop, and the stock anyways is priced for much lower growth than it is currently experiencing. So I think HIMS is a very cheap stock right now, trading at $39 to $40 a share. And LifeMD, the stock had ran up to $8 and it went right back down. And this one, why it's down is really a mystery to me, because LifeMD has a different GLP-1 strategy. Of course, to them, GLP-1 is still just a new business. It's not the main business. The main business of LifeMD is a doctor subscription. You pay $39 a month. You get one office visit a month for $39 a month. That's the Netflix of doctors. That's the business of LifeMD. A $39 a month fee, and you get a doctor visit. And thanks to that, you can treat diabetes, you can treat whatever ongoing condition you have, you can get it treated with an actual MD. They all work in this tower in New York City. I think they're on Fifth Avenue or something like that. And they have these 50-ish MDs who come to work every day, and they follow tens of thousands of patients. And that's the business of LifeMD. And of course, LifeMD has a GLP-1 offering, a GLP-1 management offering. And what they sell, of course, they sell the healthcare, the prescription, but they sell the healthcare follow-up, and they sell the doctor following you, and then they prescribe you with a GLP-1, and they try to get you to qualify for the branded GLP-1 via your insurance. And so part of the strategy of LifeMD is to sell the branded GLP-1s. And so if LifeMD sells the branded GLP-1, I'd like to know how they're impacted by the end of a shortage on GLP. How are they impacted by the end of the shortage on GLP if they sell branded GLP-1, like I said? And so, of course, they have a tiny segment where they sell the compounded GLP-1, but that's new for them. Historically, they've sold only the branded GLP-1s. So to me, LifeMD will continue to do business as usual, trying to get people to qualify for a GLP for another condition than, say, being overweight. And people can qualify for GLPs in many ways. For example, you can be pre-diabetic, and if you are, then you may qualify for your insurance to cover a bunch of the GLP-1 medication. So that's why people go to LifeMD. Different business model, but yet the stock got punished tremendously in the same vein as HIMS. And of course, LifeMD, the valuation is even lower if you remove WalkSimpli. WalkSimpli needs to be sold. They are planning on selling it. Okay, moving on to Celsius. Celsius Holdings down 14% today, and it's the second day that it's down. And I cannot understand why this stock is down so much again. I mean, are we going to get back to $24? Are we going to get back to $20, $22? Are we going to act like nothing happened? This is tremendous. There's two wonderful things that happened for Celsius. The first one is the sell-through at stores keeps growing and keeps growing. It was indeed an inventory issue at Pepsi. That's why the sales had dropped in Q2. Pepsi had ordered too much, and they're going through the inventory. And when you look at the sell-through of Celsius, the sell-through of Celsius at the stores is just fine. And sure enough, if you live in the US and you go around and you look at your stores, you will find that a lot of the Celsius flavors are gone. You go and you go see all of the flavors that they have, and you may only have a few flavors left over. You can also go on Amazon, type Celsius on Amazon, and see that they are the number one seller of energy drinks on Amazon, far ahead of the number two player. And so that was the number one worry of the market, and that worry is gone. And then the second worry that the market used to have a lesser worry was that of competition, saying, oh, well, Alani could be a competitor. Well, guess what? This worry is gone. They're acquiring Alani. Alani is the woman-only focused, well, I don't want to say men don't drink it. I'm sure there's a few men that drink it, but it's mostly woman-based, woman-focused energy drinks. That's what Alani does. Alani is extremely popular in the US, and typically you'll go to the energy drink aisle, you'll see Monster and Red Bull, and they have their own fridge, and they own 80% of the aisle, and then you'll see a fridge for Celsius, and then you'll see maybe half a fridge for Alani. This is kind of how it works. And Alani is extremely, extremely popular among Gen Z women and Gen Z teenager. And if you look at Alani, and by the way, both Celsius and Alani in a recent survey, can't remember the name of the survey, anyways, in a recent survey, they were named top energy drinks among Gen Z. Top energy drinks among Gen Z, with Alani being number 1 and Celsius being number 3. If you look Alani is $600 million trailing 12-month revenue, so the run rate is probably close to $1 billion by now. Growing at 50% a year. So Alani sales are growing at 50% a year. Celsius, 1.3 billion, growing at 33% a year. So you're looking at a business that just trailing 12 months, has about 2 billion in sales, and it's growing at 38%. So are we going to be at 2.7 billion in sales by next year, right? By February of 2026. So you're talking about a business that's trading at less than 3 times revenue. It may be trading at 2 times forward revenue if it keeps dropping, for a business which essentially doesn't really have a competitor anymore in its category. So this is the challenger. This is the business that is taking share. If you look at Monster, if you look at Red Bull, they're the defenders. They're defending. They're the ones at risk, right? They're defending. They have to defend against Celsius. And of course, Red Bull or Monster have a very hard time defending against Celsius because they operate in the extreme sports, or the sports, the high performance environment, very manly marketing. They are stuck in this marketing that is much more narrow. And Celsius is not going after them in that marketing. Celsius and Alani are never going after extreme sports. They are not going after the Monster or the Red Bull consumer. They are operating in a white market opportunity, as we call it. They're operating in a blue ocean with no competition. The competition in that blue ocean used to be Alani, but Alani was just purchased. So now it's Celsius and Alani who are operating in this blue ocean of energy drinks, going after the last coffee drinkers that are remaining, and just converting these coffee drinkers onto energy drinks. And that's the whole idea. And of course, a lot of Gen Z do not even go buy coffee. They don't go for the coffee case anymore. The coffee is not a prerequisite anymore to energy drinks. People just move straight from drinking water to drinking energy drinks entirely and avoid coffee. So this market is so interesting to me. I think this is a high growth market. Again, Monster Beverage was one of the top performing stock of the past 25 years. And could Celsius be the next Monster? Well, it's looking like it to me, and I'm happy to own it, but that's just me. That's no financial advice. That's just what I do in my portfolio. Moving on to other stocks that are on sale today. Robinhood. Look at the drop in Robinhood. It's down 30% for really the best UI in the business. I mean, Robinhood is the best broker for retail out there. They just have the best UI. I mean, I don't use Schwab anymore. I don't use Fidelity anymore. And with the hours and hours of podcasts that I listen to and YouTube I listen to every day, I can tell you that this is a sentiment that most retail investors share, which is we're moving to Robinhood. Robinhood is so much easier. The UI, the UX is just really, really well done, and it's really fast. And this is a company that's a 0-to-1 company. Of course, they invented the zero fee trading, right? They forced Schwab to do it. You may remember Schwab didn't want to do it. They forced Schwab to do it, and that was 7-8 years ago. But now they are, inventing new things like the match without an employer, like paying you 1%, 2% to move your funds to Robinhood, launching asset management, having 24 hours trading, launching index options. They are doing so many things, this Robinhood, and so it's clear to me that this is becoming the main trading platform, at least in the United States. And you can get it for cheap right now. And granted, not as cheap as it was a year ago, but I think this stock is much cheaper than it used to be. Now it's a 0.92 on my spreadsheet. It looks a little expensive on my spreadsheet, but if this is the best-in-class company in its own space, a lot of investors think it's worth it. I'm not adding to Hood at these levels. I have Hood at a much lower price, something around $13. So I'm not adding to it, but this is a stock that I'm keeping for the long run, and it's clearly a 0-to-1 stock in my view. And again, punished today, unfairly punished in my view. SOFI, let's talk about SOFI. So SOFI is just this usual story of you have your quarterly earnings, you do a triple beat, you exceed all of expectations, and then your stock dumps. It's almost like clockwork on a stock like SOFI, and we are still witnessing this major drop. So on SOFI today, luckily it only dropped 3% today, but it was down well over 5%, over 6% at one point today. SOFI was down, but if you look over, say, the past 1 month, the stock is down 23%, and SOFI is getting back into that cheap territory in the $13 range, and it is obviously on my shopping list right now when I look at how cheap it is. Looking at a stock now that is not cheap. This is the most debated stock on my channel. People always tell me, I don't understand why you're into Tesla. I don't understand why you like Tesla. Well, part of it is I got in at a much lower price. The other part of it is because I think this will be the most valuable company in the world, like it's becoming obvious to many players in this market. I was never of the era to be lucky enough to get into the Apple trade. But if you follow Apple, and one of the most exciting investments, and I'm talking about 2009, 2010, 2011. If you follow those investors and how well they did on Apple, you got to ask yourself what's going to be the company that's going to be past Apple in 2030, 2035. And the way I look at it, it's going to be Tesla. At least that's the way that I look at it. And of course, you can't look at the numbers, but Tesla's valuation is very high. It's not as nosebleed as a Palantir, but as you may know on my channel, I have this policy of I want to own certain stocks that are just best in class, regardless of evaluation. And when I look at what's happening at the auto industry, especially in light of tariff, I have a hard time imagining a world where Tesla is not going to be the number one automaker. And so you don't have to follow me on this one. Obviously, this is no financial advice. This is just what I do. But when I look at the volatility of Tesla, of course, up with Microstrategy, with Palantir, with SMCI. I'll talk about SMCI in a second. This is this stock that oscillates so fast. This is this stock that moves ups, downs, so fast. And this chart for the past 5 years, you can see it. It's been a complete mess from 400 back to the mid 100s, back to 470, right? We reached back to 470. Now we were back in the high 200s today. We were in the high 200s today. You could have gotten Tesla in the high 200s today. So who knows? Are we moving back to the mid 200s or to the low 200s? Who knows? I don't know. The only thing I know is that this market is entirely irrational, because if you look at the performance of Tesla compared to the QQQ, the triple Q, right? The best index out there is the NASDAQ. Over the past 5 years, the NASDAQ has returned 21%, but you can see the volatility of this NASDAQ has been essentially nothing compared to Tesla. Compare the volatility of the NASDAQ compared to the volatility of Tesla, right? Tesla has been a huge roller coaster. Yet, if you look at the total performance over the past 5 years, and notice I'm being fair, I'm not using the past 15 years. If I use the past 15 years, the delta between the triple Q and Tesla would be a bigger delta than this, by the way, a much bigger delta. So I'm being fair using the past 5 years. We're almost at 50% average annual return over the past 5 years for Tesla. Now, granted, that may move to like 39 or 35% if we get into the high 100s again. But nonetheless, we've handsomely beat Tesla. Again, volatility is the price you pay for higher return. And when I look at the catalyst for Tesla, of course, there's more minor catalysts like the Model Y refresh, a lot of reviews coming out, a lot of people updating to the Model Y, speaking very positively about that car. There's a lot of positivity right now about FSD in China, being entered in China and entering China, and of course FSD in the US. That's been on the news every 3 months for the past 3 months. We've been talking about FSD getting exponentially better in the US, and of course FSD is linked to the launch of robotaxi, and we also have Tesla Energy that's doing very well and that is well in the process of ramping up. And so people who bring up, the brand, Elon is hurting the brand. Well, the truth is, if you're selling batteries and giant battery packs, I don't think the brand matters very much to a utility buyer or a region that is buying a solution. But moving on, the big deal with Tesla, of course, is the robotaxi. And the robotaxi is coming in Austin. It's being launched in June of this year. In June of this year, we have robotaxi. And this is the only catalyst I can tell you about robotaxi. For 7 years. We've been hearing about robotaxi for 7 years. This is finally happening. And robotaxis are finally happening. And now that it's finally happening, the market seems to be slipping on it and giving us a quote-unquote gift. It's not entirely a gift because 7 years ago the stock was way, way, way cheaper. But this is materializing, right? We are 5 months away from reviews coming out of people filming themselves in a robotaxi, people trying it out, and this is, I think, going to lead to, let's just say some upside in the valuation. And if not, that's okay. I'll wait another year. Because you can see with this stock, with Tesla, waiting has been a paying off strategy. And I am showing you this with the data right here. You have the data right there. Look at the total return calculator, right? Based on the total return calculator, you have the data right there. You can look 50% average annual return past 5 years versus 21% for the Nasdaq. The data is in front of our eyes. Finishing up with super micro, and I was going to cover super micro, telling you how cheap it was and how down it went today. Was it down 14% today? Well, I can't tell you that because it's up. I think by the time I did the screenshot, I think we're at 20% now in after hours. So everything it lost during the trading day, it gained right back. And because they filed their 10K and the market was fearful that they wouldn't file their 10K, as if a company like SMCI would take the big risk of being delisted from the Nasdaq. No, they filed their 10K. The only point I have to make about SMCI is, again, why is SMCI loved so much by options trader? If you look at, for example, Microstrategy, whenever they compare themselves to Tesla, they compare themselves to the Nasdaq, but they also compare themselves to SMCI and Palantir. SMCI and Palantir is in the comparison of volatility of the Microstrategy annual report. When you read the annual report and the presentation, what does that tell you? That tells you that that stock, SMCI, is really, really alive and active in the options market because of that volatility. I mean, how many stocks do you see down 15% and then up 20% that often, right? And so that stock, 2 hours ago, that stock was a steal, and now it's 20% more expensive. The volatility is alive and well. I own SMCI from much lower levels than this. Well, I bought a little bit in the high 30s, but I bought a bigger chunk in the 20s for SMCI. So it's a long-term hold. It's a long-term position for me. And of course, SMCI's success is closely linked to NVIDIA's success. And it seems like the market and myself, we are all now waiting for the NVIDIA earnings that are coming up, and they, I think, will define how the market finishes the week. But anyways, these are the deals. I hope this video was helpful, and I'm sure many of you bought perhaps some of these stocks, perhaps over stocks today. And days like this were a blessing if you had dry powder, which I know many of the followers of my channel have. So anyways, this was not financial advice, not investment advice. This is just entertainment. Hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Please like and comment. Have a wonderful, wonderful day.